Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, October 30th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. The Simple Market Signals proprietary model helps financial professionals and individual investors understand the current level of risk in the stock market as well as the trend direction, allowing you to make better, more informed decisions, all for less than $20 per month. This week, we were down 5.64% on the S&P 500, and we closed at 3269.96. The first chart that we're going to look at is a 2.5-year weekly candlestick chart of the S&P 500, and the top line here is the 3330 support and resistance area, and we know over the last couple of months that has been a very important level, and of course we have now closed this week below that 3330 level. So the next area of support, of major support below where we're trading, is right around this 3200 to about 3210 area. And you know, we got down as low as 3233.94, if you can see where my cursor is circling. That's the lows for the week. So, you know, the question becomes, is that low enough to kind of give us a base to work off of? Yeah, I don't know. I mean, technically, it doesn't make a ton of sense. You know, I would feel better, really, if we had gone down to this 3200 level, because I think that might have given us a springboard to come off of. But, you know, next week with the presidential election on Tuesday, you know, anything could happen. You know, on Tuesday night, will we know who the president's going to be, or is this going to drag on and be contested? With so many people doing absentee voting, you know, guys, there's no way to know, right? So this could drag on for days or weeks. We don't know. But technically, I would be kind of surprised if we don't go down to at least this 3200 level, if not lower. So if 3200 does not hold, that 3200 to 3210 area does not hold, then the next area of support will be found around the 200-day moving average, the green line there, which right now the 200 is setting at 3119.33. That's the 40-week moving average, 200-day moving average, same thing. So about, you know, 3120 or so is where that 40-week moving average is setting. And if that doesn't hold, the stronger area of support, you know, if this sell-off continues over the next few weeks, we could find ourselves down here between this 3,000 and 2950 level. You can see here that this 3200 level extends throughout 2020 and then back into December of 2019. So, yeah, 3200 could be a decent support level, but guys, you know, until you get down to 2950 to 3000, we really don't have a super strong area of support. And you can see this 2950 level extends clear back to the summer of 2018. So, you know, if this sell-off continues, we could potentially find ourselves, you know, clear down here, right? There's no way any of us can tell at this point. Obviously, next week is going to be critical. I think it's almost more important that we get the election out of the way and get a definitive answer as to whether it's going to be Trump or Biden, rather than who actually is going to be the president, right? From a stock market standpoint, it's just getting the election out of the way and getting a determination as to who the president is going to be. That's going to be, from a stock market perspective, I think, the most important thing. So the longer we have this unknown hanging out in front of us, I think the more volatile these markets are going to be. Now, one thing that I think is a positive, right, if there's any positive from this week, and it was a tough week, right, but one positive I can take away here from the technicals is that the selling over the last couple of weeks has been on pretty normal volume. So at least we didn't see these super high volume spikes like we did back in March. So you know, we need to be thankful for that. This was pretty orderly selling over the last couple of weeks. Yeah, 5.5% down on 1 week doesn't feel good, but I like the fact that it didn't come on really high volume. So that is one positive to take away from this chart. The next chart that we're going to look at is a 5-day, 5-minute candlestick chart of the S&P 500. So that's just this week's trading. And I just wanted to review the blue lines here. 34.20, that was the support area that was that we were trading above coming into the week. And you can see just a few minutes into Monday's trading on the 26th, we broke beneath that 34.20 level and sold off, and then kind of went basically sideways. We were down slightly for Tuesday as well, and then gapped down at the open here, you can see on Wednesday, and then traded lower. And of course, that's when we broke this 33.30 level to the downside, was on Wednesday. On Thursday, we were positive and had some really nice market action during the middle of the afternoon on Thursday, but could not stay above the 33.30 level. We got rejected and sold off right at the tail end of the day. And then you can see today's action on Friday, where we were down 1.21% for Friday alone, and sold off, and we're trading really towards right at the lows of the day, right around 2:45 or so in the afternoon. Got a little bit of a rally into the close, as you can see here, and again closed at 3269.96 for the week, but again down 1.21% just for Friday alone. So pretty tough week here, and closed near the lows of the week, but not exactly on the lows. So again, one potentially positive thing is we didn't close exactly on the lows. And again, I like the fact that the volume this week was pretty normal volume. So hopefully it just means that this is a fairly orderly, fairly normal sell-off, and that maybe this 32.35 area, right, 33.94 to be exact, was the lows for the week. And maybe the lows of the downturn, guys. We don't know at this point. I would be somewhat surprised if that is the case. So I think we need to prepare ourselves for further downside. I think a logical stopping point at the very least is going to be somewhere down around 3,200 to maybe 3,210. And we'll be lucky if that's all we have to give back at this point. The market was so extended back here on the 2nd of September when we hit our peak that, the 200-day moving average would probably technically be a more realistic downside to this correction. But, we could, 3,200 to 3,210 could hold up. So we'll just have to keep our fingers crossed that that's as bad as it gets. Now, this next chart that we're going to look at is a 30-minute candlestick chart of the S&P 500, and it goes back for the last 20 days. And what we can see here is, of course, on this last, we know that we peaked in the market. The all-time high was back on September 2nd, but on October 12th, we hit our recent high, and we've been in a downtrend since then. And on these 30-minute candles, you can really see this. And, we peaked there at this recent high on October 12th, and we started this downtrend. And then this downtrend over the last few days has accelerated to the downside, which obviously is not good news. Again, the question becomes, have we put in the lows? I don't know. I don't know that the lows of this week are sufficient enough to, especially on normal volume, to flush out all the weak selling. So, guys, it's really hard to say, but I would be surprised if that's the case just based on the technicals. But one thing I want to point out here, guys, and this goes back to simple market signals and how I can help you, okay? And I wanted to point out that it's not just about the signals in the model. I really go out of my way to try to help you guys as much as I can, my subscribers. And on the 14th, on the afternoon of the 14th, just 2 days after, exactly 2 days, right? Because I did it in the afternoon on the 14th. I just want you guys, any of you that are not yet subscribers, I want you to understand this, okay? That because of my model, my proprietary model that took me over 20 years to develop, and it is proprietary, okay? And it's based on the stock market. But because of that, I can see what's going on in the model, and I sent an early warning email to my subscribers on the afternoon of the 14th, okay? Just 2 days after the most recent peak. And just bear with me here because I want to read you just a couple of lines from this email that I sent, because I want you to understand that with the model, I will do what I can. Even if the signals don't change, I go out of my way to try to let you guys know that there's a potential for something to happen. So I try to do that when I can. So anyway, bear with me. Here's the exact verbiage from that email that went out on the 14th, and then we'll get back into another chart. Again, this is the verbiage from the email. In looking deep within the Simple Market Signals proprietary model, many of the indicators within the model are near the highest readings they achieve before a market sell-off. And again, this is what I sent out on the 14th, okay? Additionally, as I went on in the email, as I have pointed out numerous times in the recent past, the market is trading well above its long-term moving average, making it vulnerable to a pullback. The above information does not mean the market cannot go higher in the short term. However, once the current combination of readings within the model are achieved, the market will often, but not always, pull back to or at least towards the long-term moving average, 200 moving average, of course, is what I was talking about, within a 2-week to 3-month time frame of achieving those readings. So again, the readings that I was saying right here in the model, I was warning my subscribers, and I did the same thing back in February, guys, before the sell-off, that happened a couple weeks later, because I can see within the model when certain levels are achieved. The thing is, the model is peaking, right? And generally, once that happens, we're going to pull back towards and oftentimes to the long-term moving average. And so that's just one example of how I can help you. But kind of going back to that movie, right? Jerry Maguire, if you remember the movie, and remember the one line in there, help me help you, okay? And guys, please help me help you, okay? Help me help you by subscribing. Guys, it's less than $20 a month. It's a smoking value. For my own benefit, I should be charging more, but I want people that want it to be able to afford it. It's $19.95 a month. That's less than 67 cents a day. So anyway, I'll tee up some more information about Simple Market Signals here in a minute, but I thought I would share that with you that, subscribers got that email on the 14th, and there's been several things that's happened in the model since that went out, but I give you guys a ton of great information in these videos, but my best stuff I have to save for my subscribers. So with that said, let's move on. And again, just remember that we are in a downtrend, and that downtrend has accelerated. Technically it does look like there's probably more downside here, at least in the short term, and especially since we've got the election coming up in just a couple of days. So let's move on here to the triple Qs. And the triple Qs, the NASDAQ 100 down 5.39% for the week. So didn't fall quite as much as the S&P 500. S&P 500 down 5.64%, but both of them down about 5.5% for the week. The one takeaway here, again, this is the 40-week moving average on the triple Qs, and look at that gap, guys. Even though we're off of the highs, we are still trading well above the long-term moving average on the triple Qs. So, the potential for further downside there, especially with the high price to earnings ratios, the high price to sales ratios found in those stocks in the NASDAQ 100, and with the super high weighting towards, some of the larger stocks within the NASDAQ 100, Apple, Microsoft, and a few others. If those tech stocks continue to pull back, the reality is that, the overall market, it's going to be very, very hard for the overall market to go up if these large cap tech stocks are selling off, to any degree. So I just think realistic expectations, at least in the short term, are that we probably have a little bit more to go to the downside. Anything is possible, but just understand, guys, that we're still trading well above these long-term moving averages. Not so much on the S&P 500, but we still have a little ways to go here. But on the NASDAQ 100, for sure, we're still well elevated. Even though we've sold off the last few weeks, even though we lost about 5.5% this week, we're still well above that long-term moving average on the triple Q. So I just think, just logically, right, the potential for more downside is there. Again, what I did like about this week is that the selling over the last couple weeks, this weekend, last week, the selling on the triple Qs was on modest volume, not super high volume like back in March, or even the volume that we saw at the end of August and beginning of September. So the fact that the volume on both the S&P 500 and the NASDAQ, NASDAQ 100, the triple Qs, over the last couple weeks has been more normal, I think is a potential positive takeaway. But I think caution is still advised here, right? At least in the short term. There'll be tremendous opportunities coming out of this whenever the market does bottom. But in the short term, I think it's a little bit too premature to say that we've hit a bottom in the stock market at this point. Let me ask you a question. Do you have a stock market risk management system? something that helps you understand the various risk levels in the stock market on an ongoing basis. Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file. All right. So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy. And you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information. And you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders. Because it's probably hidden in there. All right. So you should get the automatic welcome letter and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.